Good evening, class, and welcome to our performance management class for today. We are still on the topic working capital management, part 2. Okay, today will be part 2B because we've taken part 2A in the last class. In part 2A, we talked about management of inventories. There we saw things like management of inventory using the EOQ. Then we saw how we can get an advantage using the bulk purchase to give us a bargain price that will be better than EOQ. We also saw that when using EOQ, we're able to get the least holding costs and ordering costs. But when we now looked at the purchase cost as a result of the discount from bulk purchase, we found out that there could be a difference in decision leaving the EOQ to buy in bulk purchase. Then we look at stock levels. First of all, we looked at the reorder stock level, which is the level at which you will place a further order for your product. Then we now looked at buffer stock, that stock that would have saved you a lot of trouble from going into stock out. That stock that you fall back on when you are expecting your supplies to come and perhaps your supply lead time is uncertain. We looked at the minimum stock level, the maximum stock level, and all that. We're going to use that idea again. We will be looking at management of cash. Then we look at just in time, and just in time, we learned that it helps us from not keeping stock. And so there will be no holding stock, no holding cost rather, but you may have ordering costs because you'll be ordering more frequently and you will not be holding any costs. So you get to see advantages and disadvantages of the just in time. And we said that just in time, we focus on quality and efficiency. Today, we'll be looking at management of receivables and payables. Now, when we talk about receivable and payables, we are talking about one person in the opposite side of the equation. So it means that if you give out goods on credit, you are a creditor, and the person owing you is a debtor. If you receive goods on credit, you are now the debtor, and the person giving you is a creditor. So what applies to receivables also applies to payables. What are the costs and benefits of giving your goods on credit, or perhaps you receiving goods on credit? Business entities that sell to other businesses normally sell on agreed terms. Often, the standard credit terms is that you pay up on or before 30 days, or sometimes on or before 60 days from the date of the invoice. Okay, sometimes too, you see most sales customers, perhaps these are walk-in customers, are for cash. But you know, many businesses sell on credit, because if you don't sell on credit, you might lose this business. If a customer is allowed to pay 30 days to an invoice, it is generally assumed that the customer will not pay until day 30. Of course, it plays out that way. If ICANN tells you that you have until the end of the month to pay your exam fee, otherwise you will not write the exam, some people will wait until the last week before they pay, or until the last day before they pay. This has plays itself out in people who want to pay tax, like VAT, PAYE, and all that. They wait until the very last day or two before they pay. That is how customers usually behave. They wait until they would have exhausted the maximum possible allowance before they pay their debts. Now, what are the benefits of giving out your goods on credit? One, your sales volume will be high, and higher sales volume will result in higher contribution and higher profit. So you see, you are giving out your goods on credit, more people will buy from you. If you do not give out goods on credit, more good customers are likely to go and buy from your competitors who will give them credits. What are the costs of giving credit? There are several costs associated with giving credits. For one, there is the finance cost. By finance cost, it means that your trade payables must be financed. And the longer the period of credit you give to the customers, it means that you must invest more in your working capital to accommodate that longer period you are giving out this credit to your customers. So the cost of investing in trade payables is calculated as average trade receivables in the period multiplied by the cost of capital for the period. Now we're assuming that you're going to take a bank overdraft, and the interest rate is the cost of capital for the receivable. So the average trade receivable is the beginning trade receivable plus the closing trade receivables divided by 2, give you the average, multiplied by the cost of capital for the period. Now, that's for cost of finance. You have to finance payables given out to customers. We have bad debt costs. When you are giving out goods on credit, you are setting yourself up for bad debt. There are some who will want to owe you and stretch the debt such that they become bad. Sometimes you now make provisions for debts that you may not recover, so that you will take care of it in your profit statement. But sometimes some of them go bad automatically and you have to write them off. If you had not given these things on credit, you would be incurring bad debt. So anytime you are giving out goods on credit, you are telling yourself that it is possible this customer will not pay me and it will become a bad debt. Then there is administration costs. Additional administration costs might be incurred in negotiating credit terms with customers and monitoring the credit position. For example, now the person is not paying you, you're telling him, please come, let's look at your books again. Okay, I'm going to give you discounts. I'm going to also, okay, the cost of monitoring, going to his office, calling him, come and reconcile his position, come and pay his debt. These are administrative costs. If you have not given out this credit, you won't be doing all of that. And so another one here that is not written here is if you are giving credits, we said it will lead to higher volume of sales. Okay. Now we learned in the last one of the lectures in working capital that when your sales is too high, very, very high, it may lead to over trading. And so it also means that because you are trying to do some turnover, you may run into over trading problems. Let's look at an example of cost of giving out credits. Look at this company here called a Green Company. They currently offer customers a 30-day credit. Their annual credit sales are 12 million naira. And the contribution to sales ratio is 25%. Now, what it means is that 25% of sales is their contribution. Then it means that 75% is variable cost, because we know that sales minus variable cost will give you contribution. And if contribution is 25%, that means 75% would have been variable cost. So 25% of your sales is contribution. And bad debts are 1% of your sales. It means that these are credit sales that you could not recover, 1% of them. The company has estimated that if it is increased, that is if the credit terms is increased to 60 days, the total annual sales will increase by 10%. That means 10% of 12 million will give you 1.2 million. To increase by that, but the bad debts now will now rise from 1% to 1.5%. The cost of capital for Green Company is 9%. Now we are assuming that a day has 360 days. Let's say 360 working days or so. Estimate the effect that you see here, the effect on the annual profits of increasing the credit period from 30 days to 60 days. So what is the effect of changing the credit terms? You are giving them 30 days before, but you have now made them to collect 60 days. What is the effect? Now let's see the effect of increase. We said the sales is increased by, let me get the question open here. We are told that the sales increased from 30 to 60 days by 10%. So what is the effect of increasing from 12 million that you are having when you are giving 30 days credit to 13.2 million, which is a 10% increase? Now look at current average receivables. Current average receivables is that 30 days is when they pay. That's the credit terms, 30 days out of 360 days. And your credit annual sales is 12 million. So if your annual sales is 12 million and you are giving out credit on 30-day basis out of 360, it means at the end of the year, your receivables will be 1 million. Now, if we are to change the credit terms to 60 days and your sales increase to 3.2 million, then your receivables at the end of the day will be 2.2 million. So what is the increase? it means it has increased by 1.2 million. So from 1 million to 1.2 million increase, giving you 2.2 million. So that it means that your average receivables has increased by 1.2. Now, what is going to be the annual increase in costs? What is the annual cost increase? So if this is the increment, 1.2, and we have said that the cost of trade receivables is 9%. You can see it here. The cost of capital for green company is 9%. So you look for 9% of 1.2. That gives us 108,000. It means that the finance cost for this increase alone is 108,000. All right, now let's look at another analysis here. Annual contribution. Let's look at whether this is okay. Annual contribution when the credit terms was 60 days. Now, annual contribution we said is 25%. So if you are to look at 25% of 2 million, you will say 0.25 times 12 million. That will give you 3 million. That's what we have here. Now, if you are to change the credit terms to 60 and you have 13.2 million, look for 25%, that will give you 3,300,000. That means your contribution would have increased by 300,000. So you see, as you increase your credits from 30 to 60 days, you are increasing your annual contribution by 300,000. Now, if you look at it now, 300,000, you have incurred a cost of 108. That is not the only cost you are incurring. You have bad debts. What is a bad debt? Now, normally we said our bad debt when it was 30 days, we had 1% of 12 million. 1% of 12 million is 120,000. Now, if we increase the debt period to 60 days, our bad debt will increase to 1.5. So if you look at 1.5 of 13.2 million, we are getting 198 million. So what is the increase? It's 198 minus 120. It means 78,000 is the increase in bad debt. So yes, you are happy you paid that 300,000 naira increment in contribution. But look at it. Your bad debt has increased by 78. Not only that, your cost of finance has increased by 108. When you add them together, you have a total extra cost of changing the credit term from 30 to 60 days. The extra cost is now 186,000. Meanwhile, your extra contribution is 300. It means that if you minus 186 from 300, it means that you are going to get an extra gain of 114,000. So in that instance, from this calculation, it makes sense to increase your credit terms from 30 days to 60 days because just that increase is bringing you additional gain of 114,000. So you have looked at the cost benefits and you see that the benefits outweigh the cost. You take that term. But if the benefit is not up to the cost implication, then you will not do that. All right, now management of the trade receivables. How do we then manage our trade receivables? We've seen that giving credits to customer have their costs and its benefits. Now, this cost must be kept under control. How do we keep this cost under control? It is by managing our trade receivables properly. How do we do that? There are things you could do. For example, you could decide whether to give some customers credit and how much you should give them. Okay. So when you are trying to decide who to give credit, how much to give them, how long they should take, you should look at your existing customers and also look at those that are new customers. So those that are existing customers, you already know them. You know their history. You know those who are able to pay in time. You know those who will stretch you. You know those who will likely dribble you. And so after succeeding in collecting all your debt from them, will you want to give them it again? You will not want to give them credit anymore. So you know from experience whom you can extend credit and whom you will not. But for somebody who is coming to the for the first time, that's a very risky situation. So you may need to carry out a variety of checks. You may need to ask for trade references from other suppliers to the customer. So you may want to ask them that, where were you getting your supplies from before? Because some people will be owing from one place, and when they cannot pay, they run to another place to go and get a clean slate and start all over. So you ask for references from other suppliers. Sometimes you ask references from the bank of the supplier, of the customers. You may also want to check if the customer it's a problematic one he has had a court judgment against non-payment of debt, has it been taken to court? Know that you may ask for a copy of the most recent financial statement and carry out some ratio analysis to see if the liquidity position and maybe the working capital management and other ratios we did in part one will make the company a very good company to do business, credit business with, or if there are red flags or risk involved in giving out a loan. And sometimes you may want to go through credit agent to do a background check of these customers and see if it is good for you to give them credit. Okay, then when you are giving out credit after you've seen that, yes, this person is satisfactory, it would be good to give him a credit, then you may need to set the credit terms which should be followed. Now, in credit terms, I mean that we should have a credit period. So it should be stated in the invoice that you have to pay within a certain number of days. So sometimes you see invoices will tell you maybe 2% net 30. Now my attention here is on net 30, means the net period you must pay your credit is 30 days. So you have 30 days or perhaps 60 days, it depends on the transaction, or 90. So there must be a credit period which should not be exceeded. Knowing fully well that customers will want to pay towards the end of that credit period, so you need to learn to set a very good credit period. Not only that, there should be a credit limit. This is the maximum amount of credit that the customer is permitted to take at the time. You know, any credit you give out is a risk. The person might not pay back. Any unforeseen occurrence could happen. The person might also be declared bankrupt. The person might die. You might lose that credit. And so look at a maximum credit limit that you can afford. Also, be wary for first-time new customers. You may want to start small with them until you can trust them to give them good amount of credit limits. Then you may want to put interest charges on overdue payments. You are giving them incentives before to pay up, let's say 1% next 30. You are telling them that if you pay 1%, if you enjoy your discount of 1% if you pay within maybe 30 days. So when they are not also paying, they are stretching you, you should also state that you are going to be paying interest charges, because when you are giving a customer credit, you are financing his business, so you have a right to get your finance charge from this overdue payment. So you have to, give interest charges on overdue payments. Okay, then this is all about giving out credit. We look at whom you will give, their reputation, then you speak terms, credit terms. Now you've given out this credit, companies should have a system for monitoring payment of invoices by customers. A regular report should be produced listing all the unpaid debts and which of these are overdue. So there's something called debtors list. You see the age of receivables, debtors receivable, age of the receivables. By age of receivables, we mean that how long has this debt been there? Some people's debt might be 2 months, 3 months, 5 months, even 1 year, and they're not doing anything about it. So you must be monitoring the payment and be taking precaution in order to see that your debt has been fully recovered. Then you will also have an efficient collection system of your debts. When debt is given to customers, there should be an efficient procedure for ensuring that customers pay on time. What are those things you should do to show that customers pay on time? One is sending invoice to customers promptly as the goods or services have been provided. What is the advantage of sending these invoices? At a spot, the customer knows his debt, how much he is paying. He is not in doubt that he has incurred this cost. If you don't send invoices, the people will not be accountable. So it means that maybe the invoices has come a day, 2 days, 1 week, you have been giving invoices. There will be a need for you to send regular statements to credit customers. So it could be a weekly thing. Maybe on Monday, you review the invoices you sent to the customer. So you may have a customer's account. The invoices to you send to the customer during the week, and how much you have received from the customer during that week, and the balance. So you need to send regular statement of account to show how much the debt is being collected periodically. And so this will act as a reminder that they should make payments for what has been collected, and they should not abuse the credit terms. We also have to ensure that the credit terms are not exceeded, and customers are not allowed to take more credit than is agreed. So they must have to clear the debt first before they request for another one. So that's one. So you are sending them invoices, sending statements, ensuring debts do not go above the limit. Then you have told them that this is their debt. You need to chase them to collect overdue payments. You need to send them, you need to make phone calls, call them on the phone, tell them, look, I've sent you statement of account. This statement of account was for you to look at your statement and reconcile what you sent with yours, or come to the office and let's do the reconciliation. Please, can you come to the office now and let's do reconciliation? Meanwhile, we'll stop giving you products. And you know something? When you send them this phone call, begging them for credit that they begged you to collect, they may want to start going to other places to now buy because you have been disturbing them. And so there may be a need for you to send them reminder letters that, look, yeah, our good customers, for continued relationship, please come and pay your debt. After the first letter, the second letter may need to take a decision to withhold further supplies until credit is paid. In some extreme cases, you may need to use a debt collection agency, you may need to bring a lawyer, you may need to threaten lawsuits, and you may need to make good your threats by taking legal action. That way, when you have threatened legal action, they know that, or you are using a debt recovering agency, they know that if it enters their credit record, it will spoil their record. So can you imagine a company maybe like Dangote being, you're using a credit services, debt collection service to collect a debt from Dangote, or send him threatening legal action? That will not speak well. So there are some companies who want to maintain their reputation so that they could enjoy credit facilities. And so you have to take it softly with them at first. Then if they're not complying, you take the hard way. Then you need to reduce your bad debts. There are several ways in which you could reduce your bad debt. Okay, more extensive and careful credit checking procedures should be employed when deciding whether to give customers credit or not. Because you know, when you give credit, you are incurring bad debt. You also have to get a more efficient collection procedures, and also reducing the amount of credit in total. As the total amount of credit given to customers increases, it will result in increase in the cost of bad debt. So you should have to reduce the total number of credits that will lead to bad debts. Let's look at this example here. A company has an annual sales of 20 million naira, and all customers are given up to 60 days to pay their debt. So that's the credit period, 60 days. Gross profit on sales is 40%, meaning that 40% of sales is gross profit. Currently, bad debts are 1.5% of sales. Cost of capital of the company is 10%. Management is concerned about the high level of bad debts, and they estimate that by reducing credit terms to 30 days for all customers, bad debts can be reduced to 0.5% of sales. However, total sales revenue is likely to fall by 5% as a consequence of making the credit terms less generous. So they're going from 60 days to 30 days, your sales will fall. Now we are asked here to estimate the effect on annual profit of reducing the credit terms from 60 days to 30 days. Remember, we did before increasing the credit terms from 30 to 60. We saw it was good. But now let's see whether reducing from 60 to 30 based on this current situation will be good. Look at the current situation here. The gross profit on current level of sales, which was 20 million, 4% of that will give you 8 million. And the current average trade creditors, we are taking 365 days in a year, 60 over 365 days of this 20 million sales, it means your receivable stands at 3.29 million. Then your bad debt level, 1.5% of 2 million, it stands at 300,000. So we've seen gross profit 8 million, current debt is 3.29 million, bad debt is 300,000. Okay, what is the cost of investment in trade receivables? What is the cost of investing in receivables? We said the cost of capital is 10%, 10% of 3.9 million of your current debtors gives you 329,000. That's the cost of incurring that debt. Then the cost of the bad debt will also increase the cost of incurring the trade receivables, which is 1.5%, which gives you 300. So you see here, the cost of receivables plus bad debt has given you 629,000. That's not all. Now, when you reduce the credit to 30 days, now what's happening here is that your average trade receivables will be 30 days out of 365 days. But you see here that instead of 20 million you are selling, your sales would have fallen by 5%. So you are selling 95% of 20 million. So that means that instead of making 20 million, you are having 95% of that, which is 19 million. So 19 million will be your average trade receivables. Average sales. And looking at 30 days interval, it means your receivables will become 1.59 million for just 30 days. Okay, so let's see here. Okay, 0.5% of sales. That is why we are talking about 95%. Sales is 5% likely. Okay, so 5% less than 100, which is 95. Now, bad debts now will be 0.5%. We are told that your bad debt will become reduced to 0.5% of sales. So if your sales is 19 million, which is 95% of 20 million, which is 19 million, 0.5% of that will give you 95,000. So what will happen? The gross profit will have fallen. Your gross profit was how much? 800,000. And because your sales revenue falls by 5%, your gross profit will have fallen by 5%. So the difference between the revenue, your profit, gross profit will fall by 5%. That means to fall by 400%, 400,000 naira. So it means that you're having a gross profit of 8 million before. If it falls by 400,000, you'll be having 7,600,000. So 400,000 is the gross profit you have lost. What about the cost of investment in trade receivables? It's a cost. 10% of your 1.56 million, which is your average receivables, is going to give me 156,000. So you see your fall in gross profit is a cost to you. Your cost of investment in trade receivables is 156,000. The cost of collecting bad debt, is 95,000. When you add everything here, it gives you 651,000. That is the cost of giving credit on 30 days. So you see here that the effect of offering stricter credit terms will be an annual reduction by net profit by 22,000. It means that if your cost went up from 629 to 651, it means your cost increased by 22,000. That increase in cost will reduce your profit. And so in that case, it will not be good if you go on 30-day credit. So you still need to give them 60-day credit so that you will not reduce your profit. Now we talked about management of trade payables and receivables, talked about the terms of credit and all that. Let's look at debt factor and invoice discounting. This is another way to manage your trade payables and receivables. Now, what do we mean by trade debtors? Just a moment, please. Debt factor and invoice discounting. Who is a debt factor and what service do they provide? Now, companies that go to meet debt factor to assist their management to collect their debts, they have a reason for that, because debt factors are specialist organizations that provide a number of services that might be useful to the company. For example, they could assist companies that are having weak debt or inefficient debt collection facility to collect their debts, to administer their trade receivable ledger. Now, when they do that, they are collecting these debts from their customers. Not only that, they are giving them cash up front. They are giving them cash up front to finance their business. So it means that the business may be in the very tight liquidity position. They will go to debt factor, they will pay them. These people will give them cash up front, say about 80% or so of their debt that is yet to be collected. And then the debt factor will administer this service to them. And in some cases, this debt factor is providing insurance against bad debt. It means they are telling you, you will not take the hit when a bad debt occurs. It means that if a bad debt occurs, they are not unable to collect the debt, completely. They are the ones that will suffer the bad debt. You, the company who has employed them, will not get the hit of a bad debt. So that means for you to enlist the services of a debt collector, you must have a large number of credit sales and your customers are not paying up. You must have an inefficient procedure for collecting debt. That's why you could not collect them yourself. You need to employ the services of a debt collection, and you do not have sufficient finance for your working capital. So because of your working capital needs, you may need to collect services from the debt collectors. And so they provide administration services, credit insurance, and debt finance. So we have talked about all of this here in our discussion. So what are the costs of factoring debt factoring services. The cost of using a debt factor service includes the service fee you are going to give to the debt factor for collection of your trade receivables. Then also a commission charge based on the total amount of trade payables, because they are taking the recourse of factoring your debt for you. Then there is interest charge for finance advanced against the trade receivables. Advantages and benefits of using a debt factor, said it before, they provide administrative service for you by administer your receivable ledgers. They take the hit when your customers refuse to pay all their debts, so you do not go to bad debt. They take the bad debt for you. And they also provide upfront financial support for your trade receivables. Disadvantage: interest charges on finance, on debt factor finance is likely to be higher than maybe other, like going to the bank, taking what do they call that, bank overdraft and all that. Then also it has an effect on goodwill. Okay, the factor is unlikely to treat your customers with the soft hand that you are treating them. You are treating your customers with kid gloves, you are petting them. You know, maybe you are sending somebody with a soft voice, somebody's voice as soft as mine, to go and collect a debt. And they are not taking him serious. And now the debt factor comes and his voice is very harsh and strong. Please, he's commanding you, pay up your debt or I'll take you to court. Give you a bad name, send you to prison. And so when the person struggles and pay off his debt, the customer may likely not deal with you again. So you have had a negative effect on goodwill. And also the client's reputation may be affected because you are using the debt factor. So it means that when you use a debt factor, it means that your liquidity position is so bad that sometimes it's like a stigma. Somebody going to contact maybe a kind of disease, that a financial disease, so to speak, that has a stigma. So you now, just like somebody having tuberculosis or HIV, you know, that's a stigmatized, you're being stigmatized. So when you use a debt factor to collect your debt, it has that kind of reputation that your company was going under, going bankrupt and all that. And people will be looking at you, oh, this person has weak internal control, weak collection system. Who knows if they will not run away with my money? Bad reputation. Now let's look at example here, debt factoring blue. A company has annual sales of 1 million naira. That's the annual credit sales. Credit customers take 45 days to pay. Bad debts are 2% of sales. The company's finances trade receivables with a bank overdraft on which interest is payable at an annual rate of 15%. Now that 15% is the cost of receivables. A factor has offered to take over administration of the receivable ledger and collection for a fee of 2.5% of credit sales. Wow, is it worth it? This will be a non-recourse factoring service. So it means that any bad debt that comes, they take the hit. It has also guaranteed to reduce the payment period to 30 days. So you see, the customers were taking 45 days. debt factor says they're going to reduce it to 30 days. It will also provide finance for 80% of the trade receivables. So you see here, they are going to give you upfront 80% of your 1 million naira at an interest cost of 8 naira per year. Blue company estimate that by using the debt factor, it will save administration cost of 8,000 naira per year. Those administrative costs could be cost of calling, cost of going to meet the customers, paperwork and all that. It will reduce that administrative cost by 8,000 naira a year. Required. What will be the effect on annual profit if Blue company decides to use the debt factor service? Now look at it here. Using the debt factor service, current average trade receivables is 45 days out of 365. If 1 million naira is your credit sales, that means receivables is 123,288. Now, when the debt factor come in, they reduce it by 30 days, your receivables is reduced to 82,192. Now, it is assumed that if the factor service are used, 80% will be financed by the factor at 8% cost, and the 20% will be financed by the bank overdraft. So look at it here. In the current situation where you go to the bank to finance your trade receivables, your trade receivable, the bank is taking 15% from you, and so your trade receivables, 50% of that will give you 18,493. But when the debt factor comes, they are telling you that they are going to give you 80% of your cash upfront, of your receivables upfront. So this 82,192, which they are going to collect in 30 days, they are giving you 80% of it upfront, and you're going to pay an interest of 8%. So 80% of this upfront at 8%, plus you still now go to the bank to collect the remaining 20% of this figure at 15%. And so you are going to have interest cost 7,726. So the current situation, and with the factor, you see that with the factor, your interest rate is low. And so you have a savings of 10,767 using the debt factor. So interest costs, you are saving interest costs. All right, now look at the comparative costs here. You have a savings of 10,767 interest costs. Annual saving of bad debts. You see, your bad debt is 2% of 1 million. That's what we are told here. 2% of sales. So 2% of 1 million bad debts. Okay, so you are saving yourself those bad debts. 2% of 1 million is 20,000. And we said administrative savings, 8,000 naira. So all the savings that you'll be getting, savings in this, savings in that, gives you 38,767. This is the savings you are getting. What about the costs that you are going to incur when you use a debt factor? When you use a debt factor, they are going to give you, you are going to pay them their fee, 2.5% of your credit sales. So that's what is stated here. 2.5% of your credit sales. So your credit sales is 1 million. 2.5% of that will give you 25,000. So this is their fee. And if this is what you have saved, and what you have saved is what you use in paying them, your increase in profit will be 13,767. So that's that. Using the debt factor, they have helped you to collect your debt. They have saved you interest costs, saved you admin costs. So you pay them their debt, their fee, your profit has now increased. You now have money in your hands in advance to do your business. So you want to weigh the reputational risk and the benefits of using the debt factor. Debt factor should always only be used as a last resort. Now, what is invoice discounting? Invoice discounting is similar to when a debt factor is providing you finance. But the difference here is that you are not using a debt factor. You are using your credit invoice. Your credit invoice as security to collect facility to do business. Okay, it means that your credit invoice must be sufficiently large and it must be over some period of time, and you can use that invoice as a good credit customer to collect facility. Just like saying Dangote is collecting credit facility from his customers, and Dangote has a credit invoice and he wants to get a facility from the government or from bank. He uses his credit invoices that he's owing some companies. Okay, or let's put it this way. Dangote is your customer. Dangote buy goods from you at credit. You issue credit invoices to Dangote. Dangote has good credit rating. And now you go to the bank or you go to any finance house to get money and you bring your credit invoices from Dangote as a security for that money you're going to take. So it means that they know Dangote is going to pay, and when they pay, you are going to pay up your debt. So that is the invoice discounting. Let's look at an example here. A company might need to arrange finance for an invoice of 3 million to a customer, which the agreed credit period is 90 days. An invoice discounter might be prepared to finance 80% of the invoiced amount at a rate of 10%. The company will issue the invoice to the customer for 3 million. The invoice discounter will provide the company with 80% of 3 million, which is 2.4 million. Because you have credit invoices, taking those credit invoices to a invoice discounter. Invoice discounter will give you 80%, 2.4. After 90 days, the invoice discounter will expect a repayment of that 2.4 million he has given you in advance, plus interest rate of 10%. 10% of interest rate of 59.178. So that's the interest rate is giving you. Now, if the customer pays promptly, the repayment will be made. If the customer pays promptly, that means the customer of that company pays promptly, that's 2.4 million naira that you are going to pay. You're going to pay from the 3 million naira invoice payment by the customer. And now the invoice discounter we take is 2.4 million plus the 59,178. and the remaining 540,822 will go to the company. So you see here that you have 3 million invoices. Instead of waiting for 90 days for you to pay to get that money, you take it up front, enjoy 80% of that, you pay it up front, your customer pay your 3 million, and you have used this money, you have used money to turn over your business while waiting for him to pay. So that's an invoice discount. We'll now want to go straight into management of cash. Management of cash. Forgive me, I will be a little fast in talking about management of cash. There are several reasons for holding cash. Some of these reasons are transactional reasons. You want to settle your cash expenses, you want to pay bills and all that. These are transactions you want to make. You want to settle bills, pay bills, buy things. Then sometimes you may want to hold it for precautionary measures. So sometimes somebody will tell you, please let me hold money in my hand. In case I push down somebody selling egg, I'll be able to pay that egg I've destroyed. That's a precautionary motive. So a business might hold the cash to make an unexpected and unforeseen payment. You just see a business opportunity from the blues, you see, oh, take advantage of it now, and you pay for it. Then there may be a speculative reason. So some people want to hold cash because they speculate that, you know, it may be difficult to have cash in particular period, so they hold their cash at that time. So it's just like saying that speculative reasons, fuel will be scarce, and because of that, you are buying more fuel. That's a reason for holding fuel. So there will be a reason for holding cash for speculative reasons because you think if you want to, might be a scarcity, or you want to take advantage of an attractive opportunity to pay for things on cash. Now, there are, having known the good objective of cash, what are the ways in which we can manage our cash? That will lead us to the cash models, which we call the Baumol model and the Miller-Orr model. What is the Baumol model? What is the Miller-Orr model? Let's talk about the Baumol model. Baumol model is based on the principle of EOQ. So it means that if you know EOQ so well for inventory, you can convert that principle for cash. And so it means that you're going to tweak some aspect of inventory to suit cash so that you can use the same formula for cash. Now look at the things here we are going to use as assumptions for EOQ for cash, which is the Baumol model. The company uses cash at a constant rate throughout the year. Just like demand, we said average demand for each year for inventory, constant use of cash for the sake of cash. The company can replenish its cash immediately as soon as the cash runs out. Remember when we are doing EOQ, we said the inventory is replenished when the inventory level reaches zero. So it reaches zero, you replenish it with the EOQ, so your volume runs from zero to EOQ and all that. The same thing is applicable to cash. As soon as your cash runs out almost zero, your cash is replenished. Now, how is your cash replenished? By selling short-term investments. So this could be the sale of stock, shares and stocks and all that. So these investments earn interest. And so the amount of investment, so the volume of stock sold and the amount of cash gotten from selling this investment is what we call X Naira. Now, holding of cash, similar to holding costs for inventory, holding of cash has a cost. What is the cost of holding cash? It is the opportunity of not investing the cash, because you're supposed to invest the cash and you choose not to invest it, you want to hold it for speculative reasons. So what is the opportunity cost of holding that cash? What is the cost of holding that cash? Is the opportunity cost of investing. And it is going to be expressed as an interest rate, always given as an interest rate per year. So in some example, if it's 4% per year, you need to convert it to decimal. Then the economic order quantity, the EOQ itself, is in cash now, is the total transaction that you need to sell. You need to sell in order to raise the particular amount of cash you need. And so we also have a transaction cost. The transaction cost is similar to the ordering cost that you use in EOQ. So looking at the question here, we're going to be seeing how the BOMO model applies. Entity KL makes payments to its creditors of 3 million naira a year. So that's the volume. Just like that's your quantity demanded in a year in terms of inventory. At an equal rate each day. So yeah, you're seeing day. They are making payments each day for a year. Each time it converts investments to cash. So the transactions is convert investments to cash so that you can pay your debtors. It pays transaction charges, which is the ordering cost, so to speak. Transaction cost of 150. The opportunity of holding cash, that's the holding cost, rather than investing it, is 6% per year. You will need to convert the 6% to decimal. Using the BOMO model, calculate the quantity of investment, that's the economic quantity, that should be sold whenever more cash is needed. Use the EOQ formula 2DCO all over C6 square root. So the 2 is the formula, holding costs, ordering costs rather is 150. The annual demand, which is the payments to creditors, is 3 million. Then the holding cost here is 0.06. When you divide and square the square root there, it means that 122,475 naira worth of investment is needed. So it means that you are going to sell investment worth this amount whenever cash is needed. So if you round it up to 122,500, it means that each time you want to make payment to creditors, you must sell investment worth 122,500. That would mean that if you have to pay a debt of 3 million throughout the year, taking it 122,500 per order or per transfer, it means that you are going to make between 24 and 25 cash transfers throughout the year. How do you do that? 3 million divided by 122 gives you 24 point something. That means between 24 and 25 transfers, which is like orders, 25 orders. You are going to meet up your demand of 3 million taking it 122,500 at a time. So bottom line here is Baumol model is the EOQ for cash. Now, what about the Miller-Orr model? The Miller-Orr model is fashioned in the same way as we have the other inventory levels, where we have reorder level, minimum level, and um, maximum level. So here, the Miller-Orr model recognizes that cash flow is uncertain, and so it decided to bring those safety levels. So your minimum cash level is the level at which you will not go below. So the lower limit is the minimum you should not go below. It means that once your cash level hits the lower limit, that's a bad signal that you are getting dangerously out of cash, going out of cash. So what happened? You will need to buy more invest. You need to sell more investment. So you are selling more investment and converting it to cash. So how much investment are you going to sell? You must convert investment that will make you move from your lower level to your return point. So your return point is like your starting point, the point where you say all your marks, your reset point. So when you hit the lower button, you press the reset button, it takes you to the return point. So it means that you're going to sell cash, securities or investment that will make you move from a lower level to your return point. When the cash is going and you're getting more cash and you hit the upper limit, you are getting too much cash, which does not yield any benefit to you. There will be a need for you to take away cash into the system. Once again, you press the return button, reset button, brings you to the return level. So it means that you are going to buy more securities and spend cash, take away cash into the system, buy more securities, buy more investment, and that will bring you your cash level to your return point. And so the difference between the upper limit and the lower limit is called the spread. That spread is very, very important. The spread formula is always given to you in the exam. Now, the spread is also looked at it this way. The difference between your upper limit and your return point is 2/3 of your spread. So it means that if your spread is divided into 3, 2 parts is the part that you will need to go from your upper limit to your return point. 1/3 will be from your lower point to your return limit, to your return point. So all you need to do is to learn this formula. So I will teach you how this formula is being interpreted. The spread, the first thing to do when you are given anything with Miller-Orr model is to find the spread. Whether you are told to find it or not, that's the first thing, it's a requirement. Now the spread is 3 times big bracket 3/4 times transaction cost times variance of cash flow all over interest rate as a proportion. Close the bracket, raised to power 1/3. How do you calculate this? First of all, look for your transaction costs. After looking for your transaction costs, multiply it by 3/4. So you're looking at the numerator first. You're doing everything in the bracket first. So BODMAS says bracket first. And when you're doing the bracket first, do the numerator. And I told you, look for your transaction costs, multiply it by 3/4. You are still on your numerator. What is variance of cash? Note here you're not doing variance analysis, but you are doing something called standard deviation and variance. Variance is the square of standard deviation. So if you are given standard deviation, all you need to do is find the square of standard deviation. It gives you variance. So most likely they might give you standard deviation. It's your duty to convert it to variance by squaring it. All right, so after getting your variance, you multiply it with the transaction cost, which you have already multiplied by 3/4. You have your numerator intact. Now go to your denominator. You need to look at your interest rate. They will give you in percentage. You need to convert it to fractions. So if you are giving something like 10% or maybe 12%, you need to convert it to 0.10 or 0.12. Not only that, you need to divide that interest rate by 365 so that you know the interest rate per day. Now that's your denominator. Then you will do numerator divided by denominator. You'll be having one figure in the bracket. Then you will now find that one figure raised to power 1/3. Raised to power 1/3. When you've done that, you can now multiply the answer you get by 3. That will give you your spread. Now look at this question here. Miller or model. Entity ASD decide that it needs minimum cash balance of 15,000. So that's a lower limit. It will be always given to you in the exam. It estimates that it has transaction cost of 50 naira for each purchase or sale of short-term investment. You've got that sorted out. And I told you, you always say 50 naira multiplied by 3/4. So you have 37.5. Done that. Now, the standard deviation of daily cash flow, they said daily cash flow. So you see, you need to make your interest rates to be daily. So your standard deviation of daily cash flow is 1,400. So that means 1,400 times 1,400. Because you're squaring it, that will give you 1,960,000. So when you multiply that by 50 multiplied by 3/4, you have your numerator 73,500,000. Then you have your interest rate here. The market interest rate on short-term investment is 8%. First of all, you convert the 8% to 0.08. Then you divide it by 365 to give you 0.000219. That becomes your numerator. So when you do that, 0.000219, you will have the figure here is very big. Then you look for raised to power 1/3 of that figure. Anything you get there, you multiply it by 3. That will give you your spread. So your spread is 20,843. But the spread is not what you are calculating. You are asked to calculate the upper cash limit and the return point. So now that you've gotten your spread, and I told you that your spread is also the difference between the upper cash limit and the lower cash limit. So it means that if you have your lower cash limit given to you as 15,000, all you need to do is just add spread to it. That will give you your upper cash limit. Then we also told you that your return point is going to be 2/3, 1/3 from your lower cash limit to your return point. 1/3 of the spread is the distance from the lower cash limit to the return point. So if your lower cash limit is 15,000, your return point is to look for 1/3 of your spread. Anything you have there, add it to your return, to your lower cash limit. That will give you your spread. If you are going to come in from the upper cash limit level, all you need to do is take 2/3 of the spread, which is 2/3 of 2848. Then you minus this figure you got there from the upper limit. So if you minus it from 35,484,848, sorry, it still gives you the same thing, 21,949,000. So that's the story about your upper cash and your lower cash limit. So far so good. At the end of this topic, we've been able to understand how to manage inventory, how to manage receivables and payables, and how to manage cash. We saw some similarities with cash, Baumol model to the EOQ, Miller-Orr model to the reorder level, upper level and lower level. So you see all those relationships. So you need to also remember the spread formula and how to apply it. You saw how we manage receivables and payables, all the debt factor, invoice discounting, and all the precautionary measures you take in order not to give credits that will make you pay high interest rates, get bad debt, see the cost of debt, increasing your debt from 30 credits limits to 60 credits, how it was better for you, or you get the cost benefit of that. Also doing the reverse, from reducing from 60 to 30, what is the cost benefit of it, and look at which one you will go with. So you see here that after this topic, this is a very practical topic. You could be able to see how you can apply them even in your small business, because one thing is to learn this for exam, the other is to apply them, the knowledge, in your business. So thank you so much for coming to class today. Now, our next class, we're going to take another interesting topic, which I hope will finish in one sitting. So thank you once again, and have a good night rest.